Hello everyone, and welcome you all to this webinar today about mastering breakouts and reversal for market success. My name is Ali Mortazavi. I'm the head of training and education at Errante Broker. And if you will excuse me, we will start shortly in less than 1 minute. Till we start, please, if you see my presentation and you can hear my voice clearly, please write it down through the chat box that you have, then that would be a relief to make sure everyone can hear me very well. I appreciate that. Okay, as you see, yeah, thank you so much for your feedback. As you see, our today's subject is mastering breakouts and reversals for market success. If you remember in our previous webinar, we talked about the concept of trend and its importance in financial markets. And today we're gonna have a very brief summary from our previous session, and then we will jump on the new concepts and how to use the trends in financial markets, and we will develop more practical strategies based on excuse me, FAM principles. However, before we start, please be aware that this webinar has been brought to you by Errante Broker, which is an online broker committed to providing top-tier services and building lasting and trusting relationship with clients and partners. All of the content that we are providing during this session and also the other webinars are solely for educational purposes. So please don't take them as any financial advice. All the views and opinions presented in this material are just for education purposes, because CFD products are really risky. So you really need to improve and develop your learning day by day, because the markets are changing very fast. So that's the case. We are trying at Errante to make our traders prepare to face the challenges in real world financial markets. This is the purpose of all of these webinars. Okay, so before we jump into our webinar, let me say our focus in this webinar is to equip you with the essential tools and knowledge needed to navigate the Forex market with confidence. Whether you are a beginner looking to understand the basics or an experienced trader aiming to refine your strategies, this session is designed to offer valuable insight to all of you. One of our key topics excuse me, one of our key topics today will include the dot theory and its relevance in today's trading, followed by a deep dive into the world of trend lines, breakouts, and reversals. We will explore how to identify and interpret these crucial market signals using real-world examples and detailed chart analyses. As we progress today, we'll also introduce advanced concepts like FAN principles as a conclusion of this webinar, offering you new perspective on market trends and potential trade opportunities. Throughout this webinar, remember, if you have any question, just write it down to me. I would be more than happy to have an answer for you, maybe at the end of the session. So grab your notebooks, open your minds, and get ready to embark on an educational journey that promises to transform your approach to Forex trading. So let's begin. Very well. Let's see what we have here. Let's start with the basic of market direction. When we talk about an upward or bullish direction, we are referring to a market that consistently achieves higher highs and higher lows. And uh, we spoke about this previously, that the market doesn't move in a straight line. There's always some kind of patterns. So to, let's say, distinguish the direction, the right direction of the market, is essential to look at the upward and downward direction of the tops and bottoms, not the candles, not the price solely. So we introduce the uptrend or upward movements as what refers to a market that consistently achieves higher highs and higher lows, and it's a clear sign that buyers are in control, pushing prices up. On the other hand, the downward or bearish direction is just the opposite, marked by lower highs and lower lows, showing that sellers have taken the reins, driving prices down. And then there's a sideways or natural market where the battle between buyers and sellers reaches a temporary stalemate, resulting in minimal net price movement. Moving on to the phases of the dot theory, which is the uh, principle and fundamental of technical analysis, we begin with the accumulation phase. This is the period where savvy investors start to buy or sell, often under the radar, before a new trend is widely recognized. So, uh, if you didn't participate in our previous webinar, we started with a dot theory, and we said that in dot theory, we have three phases for a primary trend. The first phase is accumulation, where informed investors start to buy or sell, anticipating the next trend. And then next comes the public participation phase. Here, the emerging trend gathers momentum as more and more traders jump on board. And if the trend is bullish, we will see a pronounced upward movement in the price. Conversely, a bearish trend will manifest through a downward trajectory. So, and finally, we have the distribution phase. This phase is characterized by the smart money, the informed investors starting to exit their positions. While the market may still seem to follow the prevailing trend, the underlying strength is waning, often leading to a plateau in price movement. And this phase frequently precedes a shift in market direction, hinting at a potential reversal on the horizon. But let's see how we can distinguish all of these phases in a real market chart. As we uh, overlay these phases onto a market direction chart, we gain valuable insight into the rhythm of the markets during the accumulation phase. You see the market, this is the accumulation phase, guys. We have a sideways direction. The market may not make significant moves, but it's setting the stage for what's to come. The public participation is where trends become evident and attract the majority of trading activity. And in the distribution phase, we witness the trend losing steam, potentially signaling an upcoming change in direction. So understanding these interplay between market directions and phases can be a powerful tool in your trading arsenal. It's not just about recognizing the trends, but also about grasping the underlying market psychology driving these trends. As you analyze the charts here on my slide, observe how each phase aligns with the market's movement, and consider how this knowledge can inform your trading decisions. Remember, the goal of a skilled trader is not just to follow the market, but to anticipate it. In this segment, we delve into the concept of trend lines. Why? One of the most fundamental tools in a trader's toolkit. A trend line is simply a straight line that connects multiple price points on a chart, giving us a visual representation of the market's movement. It acts as a support in an uptrend where prices are inclined to bounce off the line and continue rising. In a downtrend, it serves as a resistance level where prices tend to fall after reaching the line. But why are trend lines so crucial? You may wonder. They are not just lines on a chart, they are reflections of market sentiment, illustrating the battle between buyers and sellers, and they can indicate when a trend is beginning to form, which is incredibly useful during the accumulation phase. So we use the trend line concept to identify more precisely the different phases of the markets in order to identify the correct market direction. Okay, as more traders recognize and respect these lines, they gain significance, guiding us through the public participation phase while confirming the sustainability of a trend. And in the distribution phase, a break below a trend line may be one of the first signals of a trend losing its grip. It's alerting us to a potential reversal. In a sense, trend lines in general help us cut through the noise of market fluctuations to see the underlying trends. They aid in making predictions about where the market is headed, and more importantly, they assist us in making informed decisions about when to enter or exit a trade. So remember, the power of a trend line is in its simplicity and the profound insight it can provide into market dynamics. As we progress through this course, we will learn not just to draw trend lines, but to interpret them, giving us an edge in the vibrant world of forex trading. In this step-by-step guide, we will focus on how to accurately draw an uptrend line, which is crucial for identifying support levels in a rising market. Begin by scanning your chart for the significant low points or swing lows. This is the first step, where the market sentiment turned from bearish to bullish. These points here. These points are the foundation of our trend line. Once you have identified at least two swing lows, for sure we need at least two swing lows, it's time to draw your line. Start from the earliest low and connect it directly to the following higher low. This creates an upward sloping line that should sit neatly under the price action, acting as a floor that prices touch but typically do not penetrate. It's essential that this line does not cut through the bodies of the candlesticks anyway. It may pass through shadows or wicks. However, the integrity of your trend line is confirmed when the market respects these levels, bouncing off the line and continuing its ascent. So after your line is drawn and validated, extend it forward, as you see here. So this projection is where you will watch for future price interactions. If the price approaches this line and respects it, the uptrend is still in play. Remember, a valid trend line in an uptrend is a tool for anticipating future support levels. It allows us to predict where the market may find renewed buying interest and continue the upward trend. This methodical approach to drawing trend lines is a fundamental skill for any forex trader. So please, if you wonder how to draw a correct trend line, please practice it by yourself by following these steps here: identification, connecting the points, validating the trend line by watching the market. If you can see more than 2 points touching and bouncing off the your trend line, and then you can project it to the future by continue the line to the right, and then you can expect the price to just react to these levels as what you see here. Yeah, this is the way to draw a valid uptrend line. And for sure, we can do this for the downtrend line, but in that case, we need to identify a swing uh, highs in the market and connect the points, and then we need to validate the trend line by watching if the more touches we can find through this line, checking that it touches the highs without breaking through them, and then we can project it to the future. And for sure, you can do it by yourself. If we turn back to our MetaTrader 4, you see here, excuse me, then let's just jump on the latest markets and try to find a good trend lines and draw them correctly. So first of all, here you see I have a GBP USD in the 5-minute chart. If I want to draw an uptrend line, you see first I need to identify the market tops and lows. You see here I can identify the market lows or market bottoms. Yep. But one trick that I have personally, and I'm using it for many years, is that I usually consider the close price. The most important thing about the trend line is that your line should not be penetrated by any prices, any candles close below your uptrend line. That will be not something very well. But look at this. I can somehow adjust its trend line to find out if there is no price. Yep, you see, close below this uptrend line. And what you see here, after finding 2 points, I connected them and then I projected to the future to the right, and then you see all of a sudden we have had this reaction just recently. It means our trend line is still valid. So and we will see what we can do with this trend line later. Okay, as we refine our understanding of trend lines, it's crucial to recognize the features that contribute to their significance. Because the 1 million question every time is that if this trend line gonna get gets broken or not. So this is very important to know about the features that contribute to their significance. Think of these features as the personality threads of a trend line, each adding to its story and impact on the market. First, consider the slope. The slope of the trend line is the most important one. A gentle slope can indicate a sustainable trend, as you see here. While a steep one may signal a trend as advancing too quickly, and as a result, it could be prone to a sharp correction. So a more gentle or less steeper trend line means a more significant trend line. This is the first feature. And the second, the importance of touch points cannot be overstressed. Each time the price honors the trend line, our confidence in its growth. But it's not just about quantity. The quality of these touches matters as well, with precise touches serving as stronger confirmations than just near misses touches, because usually as you know, the market movement is based on the human psychology during the time, so it's really hard to find a very, very perfect shape of a trend line or very perfect shape of any other pattern in the market, because because the human psychology is playing out here. So we really need to understand that we gonna have some near misses, not perfect shapes, and not perfect trend lines all the time. So we have to find a way to deal with this. And why? And this is the reason that we try to stress out that the number of touch points are very important, because many times you see, for example, like what just I draw here as a trend line, you see there's a wick or shadows to the trend line all the time. So it's if I want to use the shadows, you see my trend line not gonna be valid. Anyway, yep. Or these are near misses points that if I zoom in, you see we don't live in a perfect world, so we can expect the price all the time just bounces off the trend line exactly at the same line. So there are always some shadows, some other correction movements, some resistances, from the, for example, sellers. You see in this candle, anyone might thought that this is a great, for example, breakout to the downside, but you see at the end of the session, the buyers just rejected all the lower prices, and they got the price back to the trend line. So these are the near misses lines, but you see we have a very reliable reaction from the price to this trend line. That's the reason that we can find this trend line a valid one. So, and you see right now sellers are excuse me, attacking this line. And also, please just open your MetaTrader 4 like me and try to identify the other trend lines. Because trend line is crucial to understand the market direction. If you can't find a reliable or good, based on the definition, good trend line, it means we are in the absence of the trend. So for example, here, this is one of the real examples on the Euro USD, again, 5-minute chart. And you see, for example, if I want to draw a trend line, the first step is to identifying market tops, because here I see the market is going down. So I can draw one trend line, a short-term trend line, like here by identifying the market lows. After finding two market tops, I can just connect the dots, and you see the result is not that great. Because why it is? Because these points are not a major market tops. So the A real market top here is this, because we are on a 5 minutes time frame. So after getting to this point and I see the price still falling down, I need to adjust my trend line like this. This is not false, it's not wrong, it's totally correct. And right now I have 2 points of my trend line. So I am allowed to continue or to project it to the right to find potential resistance points. But as you see, the market doesn't respect this trend line and it's just passed through it. So it means it's not a reliable trend line. One reason should be this is a 5 minute time frame. You see, so to have a reliable trend line, it's really, really crucial to identify the two tops for this downtrend line or the two lows for the uptrend line and connect them and project them to the future to see how it works. And if you see it doesn't work very well, so you need to adjust it. So here I see this market tops, but interestingly, this market top is not higher than this. So it's just against the definition of a downtrend line. So what I do is I chose this one and I would try to connect these two together. And the number of touch points, you see, as it's not a very reliable trend line, I have only 2 touch points out of this about the 6 market top. So it means it's not a really significant trend line. So I have to expect it to be penetrated very fast in the near future. And if I project it to the future, to the right, you see I can find a more touching points, but still it's not that reliable. So it's not a trend line that I trade based on that because I see it's not a very reliable trend line. Because using the wrong trend line may lead you to lose your money. Time frame is another defining feature. A trend line on a daily chart carries more weight than one on a 15-minute chart or 5-minute chart because it filters out the minor fluctuations, offering a clearer view of the market's trajectory. So always you can rely on the higher time frame trend line. And then don't forget the length. The length is another important feature of when it comes to significance of a trend line. A trend line that stretches over months or years tells a tale of a trend that has stood the test of time, making it key level that many traders will be watching. Volume adds another dimension to our analysis, but it's specifically for stock trading, not for forex trading, because in forex trading we are dealing with decentralized markets, so the volume doesn't represent the number of trades or number of shares. It just represents the number of prices that picked during the time. So when volume, but in a stock trading, when volume increases as the price touches the trend line, it's like the market is shouting, pay attention, because we are at the key level. So finally, consider how the market behaves around a broken trend line, like here. If it breaks but then returns to retrace the line from the other side, as you see here, after some good reaction to this trend line, then eventually it got broken, and then we see the prices just mm, rebound to this broken uptrend line to retest it from the other side. So it means this trend line now has changed its rule or turn from a support level to a resistance level. So in summary, a trend line isn't just a line, it's a reflection of market behavior. It's a slope, the number of touches, the time frame it spans, its length, the uh, accompanying volume, and its behavior past post break. All these elements together tell us the story of the market's momentum and sentiment. So we are going to step up our game with advanced strategies for trading with trend lines. These lines on our charts are more than just guides, guys. Okay, they are part of a dynamic strategy when combined with other technical analysis tools. First, we don't rely on trend lines alone. Okay, this is the first rule when it comes to trade with trend lines. We don't rely on trend lines alone. We look for confluence when our trend line agrees with signals from indicators like the RSI or moving averages we listed. Okay, this convergence of signals can also bolster our confidence in a trade. Next, we are on the lookout for bounces and breaks. A bounce of a trend line suggests the trend is holding strong, right? For example, at this point. So we can consider it as a buy signal, yeah, when it comes to trade with the uptrend line. But an ideal point for entry can be because we have a very good risk to reward ratio, we have a very great risk management here, and also we can trade this with confidence. And eventually, this the line will be held by buyers, so we can continue in the favor of the overall trend. So it's a heads up that the market might be changing its tune, signaling us to consider exiting or entering a trade in the new direction. But remember, trend lines are set in stone, okay? As the market ebbs and flows, creating new highs and lows, we adjust our trend lines. This is the rule. We need to adjust our trend lines all the time. And this isn't about being indecisive somehow. It's about being accurate. And what about those tricky false breakouts? Another thing that we really need a very good looking at the charts is looking for false breakouts. They can tempt us with false promises of a new trend. Our safeguard: wait for the candle to close beyond the trend line before we call it a true break. So you need to get a confirmation to make sure that you are dealing with accurate breakouts. First of all, you need the confluence of other indicators, like, for example, you see the RSI changing the mode or hitting a level as you see here, for example. For example, near this point, you see the RSI has just hit the oversold area. So you can be a bit confident that, okay, it might be a sign of a reverse in this minor trend here after hitting this solid uptrend line. This is one thing to consider. And also you can get another signals from the MACD or MACD. You can see here almost near the point of this bounce of, you see the MACD signaling by coming into the positive territory above the zero line and also above the signal line. So this is the one thing to consider. And also always wait for the next candle to see if it goes just in the direction of the breaking candle. So you can use it as a confirmation for a accurate breakout. But many times it happens that you see candle comes through trend line, penetrated it, but just in the following session, you see the market bounce back and just in the opposite direction, and everything uh, just gets to the previous situation above the trend line. So it means it wasn't an accurate breakout, it was a false breakout. And after some bouncing off or breaking of a trend line, please adjust it in a better shape. Another thing is a technical issue that usually comes with it, MetaTrader. If you zoom in and zoom out a lot on your MetaTrader, you might see that your trend lines, all of your lines gonna get a bit missed out from the original place that you put them first. So be aware of all of these tips when you want to trade with trend lines. In the forex market, a breakout is like a signal flare, okay, indicating a potential change in the currency pair's direction. It occurs when the price decisively crosses a well-established boundary, be it a trend line, a range, or a trading level. The power of the breakout lies in its implication. In forex trading, breakouts are not just random shifts. They often set the stage for strong trends and offer significant trading opportunities. So whether you're looking at a mini chart or a monthly overview, recognizing the breakout is key to understanding where the market might head next. Breakouts come in two main varieties: a continuation breakout. Okay, this just refers an existing trend, suggesting that the current direction is more runway. On the other hand, a reversal breakout is a game changer. It signals that the prevailing trend might be over and a new trend in the opposite direction is starting. So, but how do we confirm a breakout? Volume is our first clue just for stock trading, not in Forex. A surge in trading volume at the breakout point underscores the market's commitment to this new path. Secondly, we look at price action. This is actually our priority when it comes to Forex trading. A decisive close behind the boundary, particularly with subsequent candles supporting the breakout direction, adds credibility to the move. So in the Forex arena, understanding and accurately identifying breakouts is a skill that can unlock numerous trading opportunities. So it is totally worth it if you take it very, very seriously. So it's about reading the market signals and interpreting its intentions, a crucial aspect of successful currency trading. I would like to show you an example on my MetaTrader about the current live charts to make it more interesting for you guys. You see, for example, I see Euro USD 5 minutes. Let's jump on the daily chart and let's use our of our today's knowledge about drawing an uptrend line. And after just spotting these market bottoms, like here, like here, like here, let's see if we can draw a good trend line here. I would go with something like this. And as you see, this is an uptrend based on the definition that we explained in this session and the previous webinar, because we have the successive market tops and bottoms. Okay, and now this is an uptrend line because we just draw it using connecting the market bottoms, which are successively higher than the previous one. So right now here, as you see, we might consider it as a near misses or near missed touch of the trend line, or we might need to wait for the price to see if we see another touch of this key level. About the significance of this trend line, you see all the market bottoms have already touched this level, so this is a significant trend line. And also regarding the length, you see is from the about the early October. So October, November, and now December, more than 2 months it has been in play. So it's a bit significant trend line in terms of the number of touches, in terms of the length, in terms of the time frame. This is daily time frame. It's a high time frame for forex trading. And so you see how the recent market action just rejected the lower prices when it got near the this uptrend line. So right now you see if you want to go short on your USD daily time frame, you should consider this significant trend line here, and it brings some possibility for the price bounce off this trend line if it just fall about the 35 pips more, and then we need to wait for the market to decide which side it will choose. Okay, and on the other side, if you want to capture the momentum, you will learn how you can capture the momentum during in this session. So you see how you can draw a reliable uptrend line. So just open your MT4 and try it by yourself to find the best trend lines ever and adjust them whenever you think is necessary. So here is some couple of examples of the maybe a false breakout that I was looking for. For example, when you have a trend which is done, which is out of play, you use the let's say the lowest point and the highest point of your trend to draw the trend line. Okay, so look at this. For example, as we spoke about the false breakout and accurate breakout, you see this is a trend line, the 1 touch, 2 touch, only 3 touch, 4 touch, and it's not a very reliable trend line. By the way, you see how the penetration has happened earlier. Sorry about the 2 weeks ago. So what has happened here, you see, the first market touched this trend line here, and then the trend line rejected the lower prices and buyers came in charge and took the price higher to this high. But after that, again, bears try to push the market lower, and eventually they succeeded by this long shadow, which is 109 pips, yeah, downside movement. And the important thing is that we have something, we have a key level here because this is our last market bottom. Okay, so in terms of having a trend line, valid trend, uptrend, we need to see a higher tops and higher bottoms. But you see the following candles just continue the precedented candles direction to the down. So this is a confirmation for us that it is a reliable breakout. But for example, and in that case, it can save you for drawing a wrong trend lines. For example, look at this. If I uh, um, would have drawn my trend line like this, I might have seen, okay, this is a breakout, the price just closed below this trend line, so it might be a breakout, and let's jump on short trade. But the following candle doesn't follow the move, and just it's getting back upward. So it's very important to uh, confirm your trend line and also to confirm a reliable breakout. So let's, very good. Let's move on, guys. Yep. Okay. Moving from the concept of breakouts, we now turn our attention to reversals, a pivotal moment in the forex market, and signals a profound change in price direction. Guys, technical analysis is all about identifying reversals. And reversals are the most probable, most profitable, and best trading opportunities ever trading can have. So please listen carefully. Think of a reversal as a sea change, the tide turning with the previous price movement giving way to new opposing force. Okay, identifying these reversals is akin to reading the market's turning points, allowing us to enter at the ground floor of a new trend or exit before our current position becomes unprofitable. That's why we really each trader in forex market needs to know the best ways to identify market reversals. And there are several telltale signs of a reversal. Price action patterns is one of them, such as head and shoulders or double tops or double bottoms. They act as the handwriting on the wall, spelling out the market next move. The other one is a divergence on technical oscillators that can whisper hints of momentum loss even if the price hasn't fully reversed or has not fully revealed its hand yet. And of course, a breakout, which we just discussed, can be the drum roll preceding the ground entrance of a reversal, and it's where the breakout energy either continues the current trend or pivots, setting the stage for a new trend in the opposite direction. So as traders, we must be adept at recognizing these signals. They are the map of the market's potential paths and guiding our strategies and helping us navigate the turbulent waters of forex trading with confidence. In forex trading, distinguishing between a false and a valid breakout is key to successful trading. Candlestick charts with their vivid depiction of market sentiment are instrumental in this process. So that's why we will spend our next webinars to candlestick charts, because they usually reveal a very precious information about the market psychology and market sentiment. So consider a scenario where the price approaches a crucial resistance level. Okay, a false breakout might initially push past this level, but here is where candlesticks come into play. If you observe a doji or a pin bar that we will discuss in our next webinars, if you see these kind of candlestick patterns symbolizing market indecision anyway at the breakout point, be wary. These patterns suggests that the market is not fully committed to the breakout. In contrast, a valid breakout is often characterized by strong full bodies candles, and these candles show conviction closing well past the breakout level and indicating a robust market move. So, but for also stock trading, you have the volume in play. Volume is another critical factor. A true breakout usually rides on high trading volume, a sign of market consensus about the new direction. So low volume breakouts, on the other hand, may lack the necessary momentum and hinting at a possible false move. But candlesticks and volume alone aren't foolproof, guys. Okay, for added assurance, wait for the next candle to close beyond the breakout point. Again, I would like to emphasize this a lot. Don't get bored, please, because this additional step can help confirm the market's commitment to the new direction. Additionally, technical indicators like the RSI and MACD can provide further validation, but don't rely on these indicators solely, because the price comes first. So the best indicator in the market is the price. And we need to understand the price action on the chart, and then we use these oscillators and indicators only in conjunction with to confirm our setup, to see if they are with us on this trading setup or not. And then risk management is also paramount. Setting tight stop losses helps control potential losses from false breakouts. And remember, patience is a virtue in forex trading. Waiting for extra confirmation before acting on a breakout signal can be the difference between a successful trade and an unnecessary loss. In a sense, guys, using candlestick analysis, volume observation, and additional technical tools is a comprehensive approach to accurately identifying breakouts in forex trading. And this method enhances your ability to make informed trading decisions and effectively manage risks. In forex charts, now let's open a new window into a very, very important concept of trend lines, which is a fan principles. Fan principles are applied by drawing multiple trend lines, which we call fan lines, from a significant pivot point in the market, such as a major high or low. Okay, as the market evolves, we draw new trend lines connecting the subsequent highs or lows, and each of these lines represents a layer of potential support or resistance, with the earlier lines being stronger and the later ones progressively weaker. These fan lines serve as a roadmap of the market's journey. When the price breaks through one of these lines, it often moves to test the next line in the fan. That's why we call it fan, because there are the multiple lines. This stepping stone behavior can provide insights into the market's momentum and direction, because now you know a steeper trend line means the market has a accelerating momentum, while the gentle sloped trend line means the market is growing on its own pace and there is not that much momentum. So particularly significant is the breaking of the final fan line. Such a moment is often viewed as a strong indication of a trend reversal. So this is the way that we can use breakouts leading to a trend reversal, because as a forex trader and a market analyst, we are on our toes just to identify the reversal at the earliest stages as possible. So it's like the market saying the trend we were following is no longer sustainable and it's time for a change. When uh, we see the penetration of the last fan line. By employing fan lines in your analysis, you get a dynamic view of the market support and resistance levels. It helps you gauge the strength of the ongoing trend and anticipate potential turning points. So as you analyze your forex charts, think of the fan lines as layers of narrative into market's story, each line offering a clue about the trend's strength and direction. And this approach adds uh, depth to your technical analysis. Uh, you might get wondered at what I'm talking about, but uh, don't worry. Let's go through the step-by-step guideline to identify the and draw and interpret the fan lines in forex trading. First, we should start with identifying a key pivot point. Okay, uh, and then we need to draw the first trend line. This is a very ordinary trend line. Draw the initial trend line connecting the pivot points to the next significant high or low, and this line represents the strongest trend. This is it, okay? But at the step 3, the subsequent fan lines, because as soon as we see a penetration through the first line, we see the market gonna make a new high or new top where if it's a downtrend line, and then we will be able to adjust our trend line. But to have a fan lines, we don't adjust our first line or our original trend line, but instead we draw a new line. So we draw additional trend line from the same pivot point. Each new line indicates a weaker trend because you see the slope of the new trend line gonna decrease. So it means the momentum is the market is waning, is losing its momentum. So then we need to finalize the fan. Continue this process until the fan covers the relevant price action, and you should have multiple lines fanning out from the initial point. And if you want a real-time example, this is how it looks like. You see here, this is our first line here when we had only 2 points, and then we connected them and projected them to the right. And after with the first penetration of the first line, we got to this new market top, and then we just draw a new line from our first pivot point to this new market top. But you see it's still a downtrend, but with less momentum. And we continued it to the right. And then we saw the after this meaningful reaction to the prior downtrend line, we see a bounce off from this line, and then penetrating the second line resulted in a new market top. So we draw a new line instead of adjusting the previous lines. In that case, you see we have the fans, and it, and each time that each line is broken, you see the market reacts to it very, very reliably. And then we see the penetration of this line, and it comes with the crossing above the moving average, and then we got through to the another market top, and then we can draw the last fan line here when we see the market is still in a downtrend, guys. Why? Because based on the definition of a downtrend, we see the market is creating a lower bottoms and lower tops. Okay, so it means the last bottom that we have here, or last market low, is here just reacted to that previous trend line. So it's lower than the previous market bottom. It means we are still in a downtrend. But as you see, if we short this downtrend, we're not going to make any money because it's not a consistent downward movement in the price, and it is a very weak downtrend. So what we do is we wait for the price action first to create a new higher tops and higher bottoms in a corrective way. And then the penetration of the last fan line signals a reverse in the trend, which means the downtrend is over now and we are at the beginning of a new uptrend. So as we conclude our exploration of fan lines in Forex trading, let's focus on integrating this powerful tool into our trading strategies. Fan lines, with their dynamic nature, offer a flexible approach to both entering and exiting trades into Forex market. Because you see, uh, each fan line is acting as a reliable support and resistance level. So you can just encounter them in your trading strategies, in your risk management. You can use this level as a support and resistance level to just adjust your trade and to optimize your entry and exit points. So when considering entry points, pay attention to how the price interacts with the fan lines. A bounce off a fan line can be an excellent opportunity to enter a trade in line with the ongoing trend. On the flip side, this is one strategy, but on the flip side, if the price breaks through the fan line and then retests it from the opposite side, as you see, for example, like here, this will signal a change in trend direction, providing an opportunity to enter a trade in this new direction. For example, here you see after this bouncing off this broken trend line, the market changing its trend to upside. So it would be a good opportunity to find a buy position, the entry for buy position. So now for exit strategies, a break through a fan line can be an early warning sign of a weakening trend or an impending reversal. This is where you might consider preparing to exit your position. Particularly critical is the break of the final fan line. As you see here, such a moment often heralds a significant trend reversal, making it a strong signal for exiting a trade to either capture profits or prevent losses. Which means we are at the end of a downtrend, and for sure shorting the market is not a good idea. To enhance the effectiveness of fan lines, combine them with other technical indicators always. For instance, confirming a fan line break with an RSI divergence or a crossover in MACD can add an extra layer of confirmation to your decision-making process. And let's not forget about risk management. In the volatile world of Forex trading, stop loss orders are essential. So set these based on fan line levels to manage your risk. This is another usage of fan lines. This approach helps in minimizing potential losses while allowing room for price movement. Okay, in conclusion, fan lines are more than just trend following tools. They're versatile elements in sophisticated forex trading strategies. So whether you are pinpointing entry and exit points or combining them with other technical tools, fan lines can significantly enhance your trading decisions as you incorporate them into your trading plan. Remember that their true power lies in their flexibility and adaptability to the ever-changing forex markets. Very well, guys, I will say we got into the end of this session. Very good. I have not received any question. If you have any question, just write it down to me. If not, I'm going to wrap up and close this session with a big thanks to all of you for participating in this session today. I hope you follow us on our website and find out about our upcoming webinars, which we will continue our journey in the technical analysis by introducing to uh, another magical tools as a candlestick, Japanese candlestick charts. Thank you so much. Have a great evening. Hope to see you next time. Thank you, Mr. Alif. Bye-bye.